In a world where the value of money never sleeps, missing out on key investments could mean missing out on a future of financial freedom. Today, we're talking about the investments you will regret not making today, opportunities that could shape your wealth for decades to come. Real estate. Real estate, simply put, involves buying property like houses, apartments, or land as a way to invest money for the long term. It's like planting seeds today and reaping the benefits in the future. One of the big perks of investing in real estate is that you can earn money from it in a few different ways. For example, if you buy a house or an apartment, you can rent it out to someone else and earn rental income every month. Plus, over time, the value of the property tends to go up, a concept called property appreciation. This means if you decide to sell the property later on, you might make a profit from selling it for more than you paid. Now let's talk about some tips to make sure your real estate investment goes smoothly. First off, location is key. You've probably heard the saying location, 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 and it's true. Make sure to research the area where you're thinking of buying property. Is it a safe neighborhood? Are there good schools nearby? These factors can affect how much rent you can charge and how much the property might appreciate over time. Another important aspect is property management. Whether you're renting out a house or an apartment, you'll need to take care of things like repairs, finding tenants, and collecting rent. You can either do this yourself or hire a property management company to handle it for you. But either way, it's something you'll need to consider when investing in real estate. So, if you're looking for a way to invest your money for the long term, real estate might be worth considering. Just remember to do your research, choose the right location, and stay on top of property management to make the most of your investment. Stock market. When you invest in the stock market, you're buying a small piece of ownership in a company. Now the stock market has the potential to grow your money over time. You see, when companies do well and make profits, the value of their shares tends to go up, which means the value of your investment can go up too. However, it's important to remember that the stock market can also go down, so there's always some risk involved. One smart strategy to manage this risk is diversification. This means spreading your investments across different types of stocks and other assets to reduce the impact if one investment doesn't perform well. For example, instead of putting all your money into one company's stock, you might invest in a mix of different companies, industries, and even countries. This way, if one company or sector has a rough patch, your other investments can help balance things out. Another important thing to keep in mind is the power of long-term investing. While it can be tempting to try to make quick profits by buying and selling stocks frequently, research shows that most successful investors focus on the long term. This means holding onto your investments for many years, even decades, and letting them grow over time. This approach not only helps reduce the impact of short-term market fluctuations, but also gives your investments more time to compound, which means your money can grow even faster over time. When it comes to choosing specific investments in the stock market, there are a few popular options to consider. One is index funds, which are investment funds that track a particular stock market index, like the S&P 500. These funds offer broad diversification and typically have lower fees compared to actively managed funds. Another option is blue chip stocks, which are shares of well-established companies with a history of stable earnings and dividends. While no investment is guaranteed to make money, these options are often considered safer bets for long-term investors. Cryptocurrency. Now let's dive into the world of cryptocurrency. Cryptocurrency is a type of digital or virtual currency that uses cryptography for security and operates independently of a central bank. It's been gaining a lot of attention lately due to its potential for high returns and the exciting technology behind it. Unlike traditional currencies, cryptocurrencies are decentralized, meaning they're not controlled by any single government or institution. This gives them certain advantages, like lower transaction fees and faster transfer times. But like any investment, cryptocurrency comes with its own set of risks and rewards. On the one hand, some people have made fortunes by investing in cryptocurrencies like Bitcoin and Ethereum, which have seen dramatic increases in value over the years. However, it's important to remember that the cryptocurrency market can be extremely volatile, with prices often experiencing wild fluctuations in a short period of time. This means there's a chance you could lose a significant portion of your investment just as easily as you could make a profit. When it comes to specific cryptocurrencies, Bitcoin is by far the most well-known and widely used. It was the first cryptocurrency to be created and remains the largest by market capitalization. Ethereum is another popular cryptocurrency that's known for its smart contract functionality, which allows developers to build decentralized applications on its blockchain. These are just two examples of the thousands of cryptocurrencies that exist today, each with its own unique features and potential for growth. If you're thinking about investing in cryptocurrency, it's important to do your research and proceed with caution. While the potential for high returns can be tempting, it's also crucial to be aware of the risks involved and only invest money that you can afford to lose. With that said, cryptocurrencies can be an exciting addition to your investment portfolio, offering the possibility of significant gains for those who are willing to take the plunge. Retirement accounts. One of the most important things to remember when it comes to retirement savings is the power of starting early. The earlier you start saving for retirement, the more time your money has to grow. Even if you can only afford to set aside a small amount each month, those savings can add up significantly over time thanks to the magic of compound interest. Now, there are a few different types of retirement accounts to choose from, but two of the most common ones are 401k plans and individual retirement accounts, IRAs. A 401k is a retirement account offered by many employers, where you can contribute a portion of your paycheck before taxes are taken out. Some employers also offer matching contributions, meaning they'll match a certain percentage of your contributions, which is basically free money for your retirement savings. On the other hand, an IRA is a retirement account that you can open on your own through a bank or brokerage firm. It offers similar tax advantages to a 401k, but with more flexibility in terms of investment options. One of the big benefits of both 401k plans and IRAs is the tax advantages they offer. With a traditional 401k or IRA, your contributions are made with pre-tax dollars, meaning you don't have to pay income tax on that money until you withdraw it in retirement. This can help lower your taxable income now and allow your savings to grow faster. Plus, many employers offer matching contributions for 401k plans, which is essentially free money for your retirement savings. So if you have access to a 401k plan through your employer, it's definitely worth taking advantage of, especially if they offer matching contributions. Alternative investments. Let's explore alternative investments, which offer different ways to grow your money beyond traditional options like stocks and bonds. One example of an alternative investment is peer-to-peer lending, where individuals can lend money directly to others through online platforms, bypassing traditional financial institutions. Another alternative investment option is precious metals like gold and silver, which have been used as stores of value for centuries. These alternative investments can play a valuable role in diversifying your investment portfolio. Diversification means spreading your investments across different asset classes to reduce risk. By including alternative investments alongside more traditional ones, you can potentially lower the overall volatility of your portfolio and improve your chances of achieving steady returns over time. However, it's important to approach alternative investments with caution. While they can offer unique opportunities for growth, they also come with their own set of risks. For example, peer-to-peer lending carries the risk of borrower default, while the value of precious metals can be influenced by factors like supply and demand dynamics and geopolitical events. Before diving into alternative investments, make sure to thoroughly research and understand the risks involved, and consider consulting with a financial advisor to ensure they align with your overall investment strategy and goals. The decisions you make today can have a profound impact on your financial well-being tomorrow. We hope this video has inspired you to explore new investment opportunities. Remember to leave your thoughts in the comments, give us a thumbs up if you found this helpful, and subscribe to our channel for more actionable financial advice.